Hello, everyone. Welcome to the first session of our three-part tax saving tips for working professionals webinar series. Today's session will be an introduction into what tax planning is, why it's important, and common ways workers can reduce the impact of taxes on their financial situation. We encourage you to leave questions in the Q&A as we go along. I plan to leave 5 to 10 minutes at the end of our session to answer general questions. If we don't get to your question today, someone from the Milestone team will follow up with you in the coming days. This webinar is being recorded and will be posted to YouTube for you to reference back to. I'd like to introduce myself. My name is Kyle LaBelle, and I'm a financial advisor with Milestone Financial Planning. Milestone is a fee-only financial planning firm headquartered in Bedford, New Hampshire, with additional offices in Newmarket, in Peterborough, New Hampshire, and Westford, Massachusetts. We provide financial and tax planning advice to clients around the country. You can learn more about us by visiting our website at milestonefinancialplanning.com or by following us on Facebook and LinkedIn. We have a few admin items to go over before we begin. First, I encourage you to download today's slides by using your camera app on the QR code below. Next, we have a couple of disclaimers. Nothing you hear today should be considered tax, financial, or investment advice. Don't make financial or investment decisions based on this or any other webinar. Instead, meet with a qualified financial advisor regarding your specific goals and financial circumstances before making major financial decisions. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results. Advisory services are only offered to clients or prospective clients where Milestone and its representatives are properly licensed or exempt from licensure. If you have questions, please reach out to us at info@milestonefinancialplanning.com. Our three-part webinar series will discuss some of the most common tax saving strategies available to working professionals and how you can use these strategies to limit the impact of taxes on your situation. The next session in our series will be on July 18th. In this session, we'll dive deeper into many of the tips and techniques we'll discuss today. We'll also go beyond simple rules of thumb regarding these strategies and discuss how we at Milestone use them every day with our clients. Our final session will be on August 15th. It'll bring everything we've discussed together to show you how to combine different planning strategies to help you build your own personalized tax plan. If you haven't done so already, please visit the events page on our website to sign up for the next two sessions. You can also sign up for them by using the links on this slide. We will be recording each of these webinars, so if you can't attend a session, you can find the recording on our website a few weeks after it airs. To ensure we're all speaking the same language throughout our discussion, we'll be setting the stage by quickly reviewing the history of income taxes in the United States and how the tax system works today. This will help orient us when we look at different tax planning strategies and whether we should implement them. From there, we'll go over what tax planning is and why it's important. Finally, we'll spend most of today's session introducing common ways to reduce your lifetime tax burden so you have more money left for your financial and life goals. We will dive deeper into many of these strategies in our next two webinars, so today we'll really focus on just introducing them. Now for a quick discussion about the history of income tax rates in the US. Income taxes are relatively new in the United States and came about after the passing of the 16th Amendment early in the 20th century. This provided Congress with the right to tax income, and the specific right they have is to levy taxes on income from whatever source is derived. In other words, all income is taxable unless specifically stated otherwise in the tax code. This series focuses on many of these exclusions and exemptions to this rule, because without these exclusions, there really isn't anything you can do tax planning wise. Tax rates and laws have changed dramatically over the last 100 years and continue to do so today. This graph shows the top marginal tax rate since 1916. The top rate started around 15% in 1916 and rose as high as 94% in 1944. Today, the top marginal rate is around 37%, and this is expected to increase to 39.6% in a few years, unless Congress passes a law before then. As we can see, tax rates and tax laws more broadly have changed significantly over time. Because of this, I'm a huge fan of increasing your tax flexibility to better navigate these changes. It's important to understand how income taxes have changed over the years, as this can inform us of what might happen in the future. For instance, many financial professionals believe rates will increase in the future, especially for higher earners. This can impact what decisions you make regarding your own tax situation. While we don't know what will happen in the future, we can make educated guesses when creating our own tax plan and choosing which techniques to implement. Before we get to these techniques, let's look at how income taxes work in the US today. Again, the 16th Amendment gave Congress the ability to tax individuals' incomes, quote, from whatever source is derived. This is extremely important as it creates the foundation of the US income tax system. This is expanded upon with the Internal Revenue Code, which dictates how taxes work today. Under today's system, all sources of income are taxable unless specifically excluded within the code. Taxable items include W-2 wages, self-employed income, investment income, etc. Some notable exceptions include unrealized investment gains, income generated inside qualified retirement accounts, and municipal bond interest. My opinion is that one of the best ways to understand how income taxes work is by reviewing your own tax return. Form 1040 of your tax return acts as a summary of that year's tax situation, and you can find your sources of income on lines 1 through 8. Adding your income together provides you with what's known as your total income. This is reduced by your adjustments, which are listed on line 10. The result is your adjusted gross income, or AGI. Some of the more common adjustments to income include contributions to health savings accounts, IRA deductions, and interest paid on your student loans. We'll cover some of these later on. Please note that your AGI is one of the most important figures for tax planning, as it impacts your ability to implement many different tax saving tips and strategies, many of which we'll discuss today. You then reduce your adjusted gross income by that year's tax deductions. The result is your taxable income, which determines how much you pay in income taxes in any given year. You take the higher of your standard deduction or the sum of your itemized deductions. Many people today don't actually itemize their deductions anymore due to tax laws that happened a few years ago. So most are taking the standard deduction. Although some of the most common itemized deductions include charitable donations, state and local income taxes paid, mortgage interest paid, and medical expenses above a certain amount. You can find these on Schedule A of your tax return. Once you know your taxable income, you can calculate your income taxes for a given year using the tax rates and accompanying schedules to the 1040. You then reduce your income taxes by the amount of tax credits generated during the year. A few common tax credits include the child tax credit, dependent care credit, premium tax credit, and foreign tax credit. These directly reduce your tax burden by the amount of the credit, making them more valuable than deductions. In fact, the hierarchy goes credits, adjustments, and then deductions. What is left after accounting for your credits is your total tax number, and this is ultimately what you're responsible for paying. Finally, you reduce your total tax by any payments you've made during the year. This could be W-2 withholdings, 1099 withholdings, estimated tax payments, or any prior tax refund you applied to this year's tax burden. The result determines how much you owe or receive as a tax refund after filing your return. Something to keep in mind is just because you get a refund or owe taxes doesn't mean your tax situation was optimal. It just means that you met what you were supposed to pay. I highly recommend becoming familiar with the Form 1040 and your tax return more broadly, as it's a great way to better understand the US income tax system overall. Now that we've run through the Form 1040, let's look at how tax rates and brackets work. This graph shows the ordinary income tax brackets and tax rates for different tax filing statuses. Something we'll look at later on is capital gains rates, which is slightly different. As you'll notice, the tax rate increases as you move into higher income brackets. This is called a progressive tax system and is a key feature of how income taxes work in the United States. Currently, the lowest rate is 10% and the highest rate is 37%. A common misconception is that moving into a higher income bracket causes all of your income to be taxed at that higher rate. This is not the case. Instead, you fill up each bracket as you go. Because you fill up brackets as you go, it can make sense to give yourself more income today to tax it at a lower rate if you would otherwise be taxed at a higher rate in the future. This is known as tax arbitrage and is a key feature of tax planning. The next slide will look at how tax rates and brackets work. I'm not going to walk through this example since you have access to these slides. However, I do want to highlight a few definitions. The first is your marginal tax rate, which is the percentage of taxes you pay on your last dollar earned. In this example, John and Jane have a marginal tax rate of 32%. This means the last dollar that they earned is taxed at 32%. This is in contrast to their effective tax rate. Your effective tax rate is a better measure of how your taxes compare to your income. That's because to calculate your effective tax rate, you take your total federal income taxes paid and divide it by your taxable income for a year. Your effective rate is a great number to keep track of over time. Ideally, you want to keep your effective tax rate as consistent as possible over your lifetime, since doing so can often help reduce your overall tax burden. As part of tax planning, you can look at what your effective tax rate is projected to be in the future and look to see if it makes sense to either increase it or decrease it this year. As I mentioned, there are two different tax rates. There are ordinary income rates, which we discussed, and capital gain tax rates, specifically long-term capital gain rates. Long-term capital gain rates are lower than those on ordinary income, and it stems from gains on long-term capital gains or qualified dividends in your investment accounts. Long-term capital gains are generated when you sell an investment that's gone up in value that you've owned for longer than a year. This usually happens when you sell something in a taxable brokerage account, though it can also happen if you sell a house or any asset that's gone up in value for that matter. Qualified dividends received in your taxable brokerage account are also taxed at capital gain rates. We'll discuss these later on. For the time being, I want you to remember that income generated from investments and tax at long-term capital gains can be better from a tax perspective than income generated from working. Now that we've looked at the history of income taxes and how tax rates work, let's discuss what tax planning is and why it's important. Tax planning is the active process, and I want to reiterate it's an active process, of reviewing your tax and financial situation and making adjustments to it to help you pay the least amount of taxes possible over the rest of your life. For this series, when we talk about tax planning, we're really talking about income tax planning, opposed to estate or generation skipping tax planning. Both of these are other types of taxes covered by the Internal Revenue Code. To perform tax planning, you often need to utilize various planning techniques to minimize your lifetime tax burden. We'll cover many of these later on. Every tax plan starts with today's laws and regulations because that's what your tax situation is based on today. However, it also is helpful to consider what may happen in the future. You can look at historic rates and the economy more broadly to make educated guesses on how tax rates may change and how these changes may impact your situation. Because we don't know what will happen in the future, I'm often a fan of increasing your tax flexibility so you can adjust to changing circumstances. We'll look at ways of increasing your flexibility later on. For now, let's look at how to approach tax planning. Once we know what today's laws are and how they may change, we can start to build our own tax plans. The first step to doing this is looking at your financial and tax situation over the rest of your life. It's difficult to know exactly what this will look like, but it's possible to get a general framework in place. To do this, you want to look at your income, deductions, credits, and any other tax item that's going to occur in each and every year over the rest of your lifetime. To be as accurate as possible, you typically need to use advanced financial and tax planning software, which we use for our clients. However, you can do a rough estimate for your own situation. When doing this, you do want to be careful to account for all potential tax items and income items for that matter, and increase them with inflation. You also want to make sure that you're accounting for any retirement items as well, such as Social Security, pensions, annuities, or any other income that's going to start in retirement, such as required minimum distributions. We often see that clients have the same or higher incomes in retirement because of these sources and because they're subject to required minimum distributions, which we'll touch on in a few minutes. With this plan in place, you can see how this year's situation compares to that framework. This allows you to determine if it makes sense to implement one strategy over another. For instance, if this year's income is lower than what it typically will be, then it might make sense to accelerate income into this year, or if the opposite is true, it might make sense to look to defer income into the future. Remember, the goal of tax planning is to reduce your lifetime tax burden, not necessarily to minimize your taxes in a single year. By doing this, it allows you to keep more of your money and put it towards the things that matter to you in life. That's why tax planning is important. I know I keep saying this, but effective tax planning really does attempt to reduce your lifetime tax burden. This allows you to keep more of your hard-earned money and put it towards the things that you want in life. Taxes are often the single largest expense people will ever pay, and reducing this expense can have a significant impact on what you can do in your life. While taxes and tax planning more broadly are extremely important, there's an adage in financial planning that you don't want to let the tax tail wag the financial dog. In other words, you don't want to let your tax decisions control your financial situation if it doesn't propel you towards your goals. Tax planning should be just one element of your broader plan. It can be helpful to work with a financial advisor that advises on not just your tax situation, but your finances more broadly. Now that we have some background established, we'll spend the rest of today's webinar discussing tax saving tips and techniques. I like to break these tips up into 6 categories. The first is avoiding tax penalties and interest. The next is taking advantage of your employer retirement plans. From there, we'll look at taking advantage of other tax advantage plans. After that, we'll look at managing equity compensation and charitable giving strategies. Finally, we'll look at tactics for tax-efficient investing in taxable brokerage accounts. I do want to note that many of these tips and techniques revolve around investing in one account or another. This is because the government is trying to encourage people to save and invest for their future, and it rewards those who do so with tax breaks. While we'll discuss quite a few items throughout this series, there are numerous planning items that we won't get to. Instead, we'll focus on the most common and impactful items we use with our working clients every day. One of the easiest ways to reduce the impact of taxes on your financial situation is limiting unnecessary tax penalties and interest payments. There are many different tax penalties out there, but today we'll focus on 2 of the most common, the failure to file and failure to pay penalties. The failure to file penalty occurs if you owe taxes and fail to file your tax return on time. This is typically April 15th. The penalty is 5% of the amount of the underpayment or what you owe. For example, if you owe $10,000 in federal taxes and don't file your tax return on time, you'll have a $500 penalty for each month until you file your return. The maximum penalty is 25% of the underpayment. So in this scenario, the maximum penalty would be $2,500. In addition to that penalty, you also have to pay interest on the underpayment. For Q2 2024, the interest rate was 8% per year. Avoiding these can significantly improve your overall situation. The next penalty we'll look at is the failure to pay penalty. This occurs if you do not meet your tax burden during the year. Technically, you're actually required to meet your tax obligation for each and every tax quarter. If you don't, you can be subject to underpayment penalties and interest. The failure to pay penalty is 0.5% of the balance due per month that it's not paid. Interest also accrues on this underpayment at the same rate as the failure to file penalty. You can avoid these penalties by meeting any one of the 3 safe harbor rules listed above. Avoiding penalties and interest payments is an easy way to limit the impact of taxes on your situation. If you have a complicated income and financial situation with many moving pieces, you may want to perform quarterly estimated tax payments. You may want to perform quarterly tax projections to ensure you're on track to meet your safe harbor rules. A few ways to meet your tax obligations, if you're not on track to do so, are increasing your paycheck withholdings, making quarterly estimated tax payments, or withholding taxes from other income sources, such as inherited retirement account distributions. We perform tax projections for our clients to help prevent them from having to deal with these penalties and interest payments. The next category of tips that we'll discuss deal with maximizing your employer-sponsored retirement plans. These strategies can have the biggest impact in reducing your overall tax burden and allow you to grow your wealth to achieve your financial and life goals. Remember, the goal of tax planning is to reduce your tax burden so you have more money to use how you want in life. The Internal Revenue Code gives special tax treatment to income placed inside retirement accounts. This is in part to help encourage individuals to save for retirement and limit taxpayer dependency on government benefits and support. Contributions to retirement plans allow you to manipulate your income and taxes to your advantage each and every year. We will focus on a subset of these plans known as defined contribution plans. You can contribute and invest up to $23,000 to these plans this year through elective deferrals. There are actually several types of defined contribution plans, and you may be familiar with one or many of these. Today, we'll cover 401k, 403b, 457, and TSP plans. The plan you have access to depends on where you work. 401k plans are often offered by for-profit companies, and it's probably the most common form of defined contribution plans. 403bs, on the other hand, are offered by nonprofits or local and state government agencies. These two plans are very similar to one another, with many of the same rules and principles. The next type of retirement plan is the 457b plan. And there's really two different types of 457bs. There are governmental and non-governmental plans. As the name alludes to, governmental plans are offered to employees of local and state government organizations. Again, these are similar to 401k and 403b plans. On the other hand, non-governmental 457bs are offered to employees of nonprofit organizations. These are less similar to 401k and 403b plans, and they're typically less advantageous. It doesn't always make sense to utilize your 457b, so this is something you really want to look closely at before doing so. I do want to stop and note a unique feature of 457b plans, and that is that employers who offer these plans usually also offer either a 401k or a 403b. Additionally, you can usually contribute the maximum amount to a 457b and or a 401k plan. While if you have two 401k plans through different employers, you can only contribute up to the maximum, which again, this year is $23,000 across all of these plans. This means that you could contribute $23,000 to a 457b and $23,000 to your 401k or 403b plan. This allows you to double the amount of income that you can manipulate and control your tax situation even more. This can help turbocharge your retirement savings and reduce your lifetime tax burden. The last plan on this list is the Thrift Savings Plan, or TSP. This is the federal government's equivalent to the 401k and operates similarly to 401k and 403b plans. When talking about employer plans, we will mostly focus on the similarities of these plans rather than their differences. Now it's time to go over some of the key features of these plans. First off, they provide preferential tax treatment on contributions to the account. Secondly, money within the account grows tax deferred, meaning that you're not taxed on any income generated in the account until you take it out. Third, earnings within the plan. Third, penalties apply on most distributions before the age of 59 and a half, although exceptions do apply. There are IRS defined contribution limits for these plans. As we mentioned, this year, the most you can put into a defined contribution plan is $23,000. That said, 401k, 403b, and TSP plans have what's known as a catch-up contribution for those over the age of 50. If you have a catch-up contribution, then you can put in an extra $7,500 into your defined contribution plan. Remember, this allows you to manipulate your income and taxes to your advantage. Finally, these plans have what are known as required minimum distributions, or RMDs. Overall, contributing to a defined contribution plan is one of the best ways to reduce your lifetime tax burden and, again, enable you to save and invest more for your future goals and what you want in life. RMDs are an extremely important feature of retirement accounts and are the reason for many of the tax planning strategies we'll discuss throughout this series. The IRS allows you to put money into these plans and get tax benefits for doing so. However, they do require you to start taking money out of the accounts once you reach a certain age. You have to start taking money out of your pre-tax accounts by the age of either 73 or 75, depending on your required beginning date, which is based on your birthday. RMDs can have a huge impact on your overall tax situation, and it's possible that you are required to take more money out of these accounts in retirement than you need to live on. And remember, money coming out of your pre-tax accounts is taxed to you at ordinary income rates. If you add on the RMDs on top of other retirement income sources, it can easily push you into a higher bracket than you were in your top earning years. There are exceptions to the RMD requirements, but those are beyond the scope of today's webinar. There are three different types of contributions you can make to an employer plan. These types are traditional, aka pre-tax contributions, Roth contributions, and after-tax contributions. Traditional contributions reduce your income today, grow tax deferred, and are taxed at ordinary income when withdrawn. Also, these accounts are subject to required minimum distributions. And finally, there are no income limits on traditional employer plan contributions. This is in contrast to how traditional IRAs work. On the other hand, Roth contributions do not reduce your income today. That means you don't get a tax benefit for putting money into a Roth IRA today. However, money within a Roth account also grows tax deferred, and you can take money out tax-free in the future. This is a huge benefit in retirement because it gives you a lot of flexibility to manipulate your tax rate and potentially reduce your overall lifetime taxes. Additionally, Roth IRAs aren't subject to the RMD rules, meaning these accounts can continue to grow tax deferred and tax-free into the future. Finally, Roth IRAs also do not have income limits, which is in contrast to a Roth IRA. The last category are after-tax contributions. These are like a hybrid between Roth contributions and traditional contributions, but it's the worst part of both. Because of this, we typically don't recommend utilizing after-tax contributions unless certain circumstances apply. The decision really comes down to choosing between traditional and Roth contributions, and this is a very important decision that you have to make each and every year. Choosing incorrectly can cause you to pay far more in taxes than you otherwise would and reduce the amount that you have available to you. Here are some general rules of thumb for choosing between Roth and traditional contributions. The decision between the two comes down to whether you are paying taxes at a higher rate now or when you take money out of the account. If you are paying more now, then you want to go with the traditional contribution. For instance, if you're in the 32% tax bracket today, but after doing some tax planning, you expect to be in the 24% bracket later, then it can make sense to do traditional contributions since you get a bigger tax savings by putting money into the account than you'll have to pay when you take money out. If the opposite applies and you're in a lower bracket now than what you would be in when you take money out of the account, then you want to choose a Roth contribution. Unfortunately, we don't always know for sure what our tax rates will be in the future or what tax laws will be. Because of this, I encourage people to have a mixture of Roth and traditional assets to improve their overall tax flexibility and so they can choose from one bucket or another later on in life. Now that we've discussed traditional versus Roth contributions, we can look at one of our first true planning strategies, the Mega Backdoor Roth. The Mega Backdoor allows you to contribute more to your 401k than is typically possible. And I do mean a 401k. This is typically not possible to utilize with a 403b, TSP, or 457 account. The way the Mega Backdoor works is you make after contributions into your 401k plan and then do something called an in-plan Roth conversion. This turns those after-tax contributions into Roth contributions, where you receive the preferential tax treatment of tax deferred growth and the ability to take money out tax-free later on. The Mega Backdoor strategy allows you to save up to $69,000 in your retirement account this year. As I mentioned before, typically you can only contribute up to $23,000, so this is triple that limit. That said, the Mega Backdoor is not available to everyone, and you'd have to check with your employer to see if you can implement this strategy. However, if you can implement it, this is probably one of the best ways to minimize your lifetime taxes by contributing more money to a Roth account, which can then be used tax-free later on. Next, we're going to move on to strategies that help maximize your other tax advantage plans. This section will cover 5 different tips and techniques, each of which relate to a different tax advantage plan. As we did with employer plans, we'll start this section by comparing traditional and Roth IRA contributions. Before doing so, let's touch on what an IRA is. An IRA is an individual retirement account. Like employer plans, they allow people to save money for retirement and receive tax benefits for doing so. However, unlike employer plans, which are sponsored by your employer, this is available to individuals and you get to choose where you open up this account. IRAs tend to have more flexibility than employer plans and tend to have more investment options than employer plans. This is a huge benefit of an IRA account. However, there are some downsides. Those are lower contribution limits and income phase outs. This means that higher earners may not be able to put money into an IRA account. However, if you can, it usually makes sense to max out an IRA before maxing out your employer plan. There are also 3 tax categories of IRA contributions like there are for employer plans. There are Roth contributions, deductible traditional IRA contributions, and non-deductible traditional IRA contributions. These work similarly to employer plans, with non-deductible contributions working very similar to after-tax contributions. The difference between a deductible and non-deductible traditional IRA contribution is with the deductible contribution, you get a tax break for putting money into the account today. This acts as an adjustment to income, which we discussed earlier. However, with non-deductible traditional contributions, you don't get a tax benefit today. Because of this, the IRS says that you can actually take money that you put into a non-deductible plan out tax-free. However, the earnings on those contributions are taxable and are taxed at ordinary income rates. Because you don't get the same tax benefits from non-deductible contributions, we typically don't recommend making them. In fact, it usually doesn't make sense to perform deductible contributions either. This is because of the relatively low phase-out limit. This year, you start losing the ability to put money into a deductible traditional IRA once you reach $123,000 of modified adjustable gross income. This occurs in the 12% tax bracket for many. And this means that usually in retirement, you're going to be paying more than 12% on the money that you're taking out of these accounts. So putting money in today to get that tax benefit doesn't necessarily make sense if you're going to pay more when you take money out. We often only recommend clients make Roth IRA contributions. If your income is too high to do a Roth contribution, we typically recommend putting that money into a taxable brokerage account instead, which we'll discuss later on. While this is a general rule, it may be possible that it makes sense for you to do a deductible IRA contribution if you always expect to be in a very low income tax bracket. While IRAs have a lot of flexibility, the income phase-outs and lower contribution limits can make them less beneficial than employer plans. While we typically don't recommend making non-deductible contributions, they can make sense to do if you're trying to implement the backdoor Roth strategy. There are income limits, as I mentioned, on both Roth and deductible IRA contributions. However, there aren't income limits for non-deductible contributions. The backdoor Roth strategy is a way for high earners to make a Roth contribution when they may not otherwise be able to do so. This is a great way to increase your tax-free accounts and your tax flexibility. You only want to do a backdoor Roth if you can't do a normal Roth conversion because there are several steps involved and it can get messy. Additionally, you can really only implement this if you have $0 in all traditional IRA accounts at the end of the year. This is due to something known as the pro rata rule, which we'll look at next month. The way this strategy works is you make a non-deductible contribution to your traditional IRA. You then convert that contribution through a Roth conversion and move that money into your Roth IRA account where you get the preferential Roth treatments. We'll discuss this in more detail next time. For now, what I want you to take away is that the backdoor Roth can be a way for higher earners to increase their tax-free accounts and improve their overall tax flexibility. Additionally, you can only implement this if you don't have pre-tax IRA assets. Now let's discuss what Roth conversions are. I've already mentioned Roth conversions twice so far when referencing the mega backdoor Roth and the backdoor Roth. Now we're going to look at what a normal Roth conversion is. This is when you move money from a traditional account, usually your IRA, but it could be an employer plan, to a Roth account. When you do this, you choose to be taxed at ordinary income rates on the converted amount. This means you have to pay tax today on the money that you converted, and this money could have otherwise grown tax deferred. So you're cutting some of that growth. So why would someone do this? Well, you would do a Roth conversion if you can move the money into your Roth account and pay taxes at a lower rate today than what you would do in the future. This is one way of accelerating your income. We'll look at another way to do that in a little while. Next month, we'll look at Roth conversions in more detail and look at scenarios when it makes a lot of sense to perform a Roth conversion. The next non-employer plan we'll look at is the Health Savings Account, or HSA. HSAs allow you to save in a tax-efficient way for qualified medical expenses. This is probably my favorite way to save and invest into the future. That's because these accounts are triple tax advantage. You can put money into these accounts and receive a tax deduction today, which reduces your overall income. Just a side note, HSA contributions are actually adjustments, so they're even better than a deduction. Next, money that are in these accounts get to grow tax deferred into the future. Finally, you get to take money out of these accounts tax-free if you're paying for qualified medical expenses. You can even take money out of these accounts before you hit retirement. We look at HSAs as another type of a retirement account and usually recommend taking money out of the account in retirement for medical expenses. Something to note is that these are not use it or lose it accounts. This means that the money you put into these accounts isn't lost at the end of the year if you don't use it. Again, this is why we look at these as another form of a retirement account. Something to keep in mind is you must be enrolled in a high deductible health plan in order to utilize an HSA. And HSAs can even make high deductible health plans worthwhile even for those with a lot of medical expenses. The optimal strategy to take advantage of an HSA is to contribute money into the account utilizing payroll deductions. You would then invest those contributions so they get to grow into the future. And while they're growing, you would pay for your medical expenses out of pocket. This allows the money in your HSA to continue to grow, tax deferred, and be taken out later on tax-free. Again, we typically recommend clients use your HSA to pay for medical expenses in retirement. The next planning item we're going to look at is the 529 savings plan. These are used to save and pay for qualified higher education expenses. There are really two different types of 529 plans. The first is prepaid tuition plans, and the second is college savings plans. We typically don't recommend using prepaid tuition plans, so we'll focus on college savings plans for today's discussion. 529 plans is a way to save in a tax-efficient way for college expenses. You get tax-deferred growth on money that you put into these plans and receive tax-free and can take money out tax-free when you're paying for qualified higher education expenses. Many different states offer 529 plans, and you don't have to use your state's plan. And you don't have to use the plan for the state that your child or the beneficiary of these accounts is going to college. We actually recommend looking into different states' plans because of their investment options. Each state has their own investment options, and these vary dramatically from state to state. Because of this, it's not always a good idea to use your own state's plan, though you can get even more tax benefits for doing so. So look at your state's plan first, and then look at the other options that are out there. We usually recommend our clients use My 529, which is Utah's 529 plan. That's because their investment options align pretty closely with Milestone's overall investment philosophy, but that's outside the scope of today's webinar. Something else I want you to keep in mind is that while you get preferential tax treatment for qualified withdrawals from 529 plans, this is using money for qualified education expenses. If you take money out for non-qualified expenses, you do face taxes and penalties on those distributions. So you don't want to overfund your 529 plans. Instead, you want to put in just enough to cover the cost of college. Now we're moving on to our fourth category of tips, which is managing your equity compensation packages. Equity awards can often form a significant part of someone's overall compensation package. Properly dealing with these equity awards can help propel you toward your financial goals. There are numerous types of equity comp, with some of the most common being restricted stock units and employer stock purchase plans. These will be the focal point of today's discussion. We're going to start by looking at restricted stock units, or RSUs. RSUs are shares of your employer stock that are awarded to you as part of your compensation. You receive a portion of your awarded shares periodically based on your vesting schedule. Upon vesting, the then value of the shares are taxed at ordinary income rates and reported on your W-2. You also see these on your pay stub. However, the unvested shares are not taxable until they vest. This is because there's usually some risk of losing these shares. One of the main tax planning opportunities with RSUs is ensuring you have enough taxes withheld from your paycheck when your shares vest. This is because the default tax withholding with RSUs is only 22%. For higher income earners, it is likely that this will not be enough, and this could cause you to underpay your taxes, and you could face the failure to pay penalty. Many companies do allow you to elect to do something called sell to cover. This means that your employer will sell a portion of your RSUs as soon as they vest to cover the taxes on the vesting shares. However, even if you elect to sell to cover, you are only paying at 22%. You may be able to choose a specific withholding rate before your shares vest. I recommend reviewing your tax situation ahead of each vest to ensure enough money is being withheld for taxes. If you cannot change your withholdings, you can make estimated tax payments throughout the year to meet your tax obligations and satisfy those safe harbor rules we looked at earlier. Finally, you want to make sure that your RSUs are properly reported when you file your taxes. It's common for reporting issues to occur with RSUs, and these issues can force you to pay more than you need to in taxes at the end of the year. The second form of equity compensation we'll discuss today is the Employer Stock Purchase Plan, or ESPP. The way ESPPs work is you buy shares in your company stock through payroll deductions, and you typically get to do so at a discount. The maximum discount allowed is currently 15%, and this is determined by the IRS. Something else you want to be familiar with is your purchase period. This is the length of time that you are actually purchasing the shares of your employer stock. You typically have to determine how much money you're going to set aside to buy these stocks before the period begins. Once the period's over, that's when you are actually awarded the shares. Something to look for in your employer stock purchase plan is something called a look-back provision. If you have this provision, an ESPP can be extremely attractive. That's because this provision allows that discount that you receive to be based off of the lesser of the beginning stock price or the ending stock price. This can cause that discount to be larger than 15%. However, you do want to keep in mind that the value of that discount is taxed at ordinary income rates, and you want to make sure you have enough tax withholdings to cover it. Finally, we typically recommend that clients sell their ESPP shares upon vesting to minimize the impact of the shares going down and to lock in that discount. The next category of planning opportunities has to do with giving to charity. For those that are charitably inclined, tax-efficient charitable giving strategies can help you give to causes you believe in and reduce your tax burden. While charitable giving can help reduce your taxes, it also reduces your net worth. If donating to charity is not a goal for you, then the following strategies in and of themselves will not improve your overall financial situation. This can be an example of letting the tax tail wag the financial dog. Remember, we want to make sure that when doing tax planning, that what we're doing is helping propel us towards our goals, and we're not just doing something for the tax benefits alone. However, if you already give to charity, then doing so in a tax efficient manner can help improve your overall situation and allow you to give even more away. The first technique we'll look at is batching your charitable donations. This can be very useful if you currently take the standard deduction when you file your taxes and consistently donate to charitable causes over time. Donating to charity is one of the most common itemizable deductions. However, because of recent tax changes that occurred in 2017, many individuals no longer itemize their deductions and lose the tax benefits of giving to charity. Batching donations can be a great way to avoid this problem. The way this works is that instead of donating a certain amount to charity in a single year, like say $5,000, you would donate a multiple of this to cover your giving for a few years, let's say $20,000. This can often push people over the standard deduction and allow you to reduce your taxable income. However, if you usually donate from your checking or savings account to charity, this can dramatically reduce your cash reserves that would otherwise be used for other goals. This is where our next technique comes into play. Donor advised funds can be a great way to batch your charitable donations. We often recommend clients utilize donor advised funds if they consistently donate to charity over time and have assets that have gone up in value. The way a donor advised fund works is you would donate something that's gone up in value into your donor advised fund. Then you get a present year tax deduction for this donation, and you typically get to make grants from the donor advised fund over numerous years. When you donate money to a donor advised fund, you technically lose control over that asset, but most donor advised fund providers allow you to dictate where the grants are going afterwards. Additionally, with a donor advised fund, you can actually invest the assets within the account so they can continue to grow. This can reduce the need to make donations into the fund in the future. Utilizing a donor advised fund is one way of minimizing the impact on your cash flow of your charitable giving goals. This can be extremely important, especially in retirement. The best time to use a donor advised fund is in your highest earning years because you get the biggest tax deduction for doing this. Ultimately, donor advised funds are one of the more tax efficient ways working professionals can satisfy their charitable giving goals. And this is one example of a strategy that reduces your income. The final category of tips that we'll discuss today has to do with taxable brokerage accounts and tax efficient investing more broadly. Taxable brokerage accounts are different from other accounts we've discussed. You don't get tax benefits for putting money into these accounts, and you don't receive tax deferral on the money in the account and the income generated in the account each year. This means you have to pay taxes on the income that hits your brokerage account each and every year. However, taxable brokerage accounts are more flexible than the other accounts we've looked at. There are little to no restrictions on contributions to these accounts or withdrawals from these accounts. In contrast, employer plans have a limit of $23,000 on the contributions to the accounts. Additionally, there's usually limits on the ability to take money out of those accounts before the age of 59 and a half. Brokerage accounts do not have these restrictions. Finally, income generated within a taxable brokerage account may be taxed to you at preferential long-term capital gain rates. Again, long-term capital gain rates are lower than ordinary income rates, as we looked at earlier. Because income is taxed annually, tax-efficient investing is extremely important when dealing with taxable brokerage accounts. Two strategies for tax-efficient investing are tax loss harvesting and tax gain harvesting. Loss harvesting is when you sell a security, typically in your brokerage account, and quote unquote, harvest the loss in value. This is when that security has gone down in value, you then sell it. This can help offset other capital gains that are generated elsewhere in your portfolio. If you have more losses than gains in a given year, the result is a net capital loss, and this can help offset ordinary income. As we mentioned, ordinary income is taxed at a higher rate than capital gains, and offsetting ordinary income with capital losses can be a great way to reduce your overall tax obligation. You do want to be careful of something known as the wash sale rule, which we'll cover in more detail next time. For now, remember that capital loss harvesting can help reduce your income this year, and it's an income reduction technique. Capital gain harvesting, on the other hand, gets less fanfare in the media, but it can be even more impactful than capital loss harvesting. This is when you intentionally generate additional income by generating capital gains in your investment accounts. You typically do this to utilize a low tax bracket, and specifically the 0% long-term capital gains brackets. I recommend referring back to slide 14 to see what the capital gain bracket rates are and whether this applies to you. Capital gain harvesting allows you to generate income with little to no federal income tax implications. For example, if you generate $50,000 of long-term capital gains and all of those are taxed at the 0% capital gain brackets, then you give yourself $50,000 of income with zero tax implication. This can be a huge benefit to reducing your overall tax situation. Capital gain harvesting is another way to accelerate income into a given year, just like Roth conversions. Finally, the last technique we'll look at today is tax location. This pulls together much of what we've already discussed. Admittedly, this slide can be difficult to understand, but hopefully after explaining what tax location is, it'll make more sense. At a basic level, tax location is choosing which account type to put different assets in. There are three categories of accounts from a tax perspective, which we've already discussed. These three are taxable accounts, tax deferred accounts, and tax exempt accounts, aka tax-free accounts. Each of these different accounts have a different tax implication. Additionally, different investments have their own tax implications. Effective tax location looks at putting investments in certain accounts based on each of their characteristics, both the account's characteristics and the assets characteristics. For instance, you may want to put your highest growth assets in tax-exempt accounts to allow these accounts to grow as much as possible. This is because you do not pay taxes when taking money out of these accounts. On the other hand, you want to put your low growth assets in your tax-deferred accounts, usually your traditional IRA or traditional employer plans. This prevents these accounts from growing as much and reduces the tax volume that occurs once you are subject to required minimum distributions. Again, that happens at either 73 or 75, depending on your birth year. Finally, you want to put your most tax efficient assets in your brokerage account. That way you limit the impact of taxes on the growth of these assets over time. Because remember, your taxable brokerage account, any income generated within it is taxed to you each and every year, unlike the other two accounts mentioned. Implementing tax location can help reduce your overall tax burden by lowering, 1, your required minimum distributions, 2, improving the tax efficiency of your brokerage account so you pay less in tax each year, and 3, encouraging your tax-exempt accounts to grow as much as possible. By having large tax-exempt accounts, you can then take money out of these accounts for large expenses, specifically in retirement. Let's say you need a new car, want to do some improvements on your house, or travel around the world, but you don't want to mess up your tax situation by taking money out of one of your other accounts. You can access your tax-exempt accounts for this purpose. And by allowing these accounts to grow, tax location can help reduce the overall impact of taxes on your situation. For higher net worth individuals, this can have a massive impact on your ability to afford things throughout your life. I know we've gone over a lot today, so before we wrap up our first session, are there any questions? So it doesn't seem like we have any questions. So on behalf of Milestone Financial Planning and the rest of the Milestone team, I'd like to thank you for attending today's session. As a reminder, our next session will be on July 18th, during which we'll elaborate on many of the planning techniques discussed today. We will be posting a recording of today's webinar on our website and YouTube in the coming weeks. So if you want to go back and reference something we talked about, please feel free to check our website and our YouTube page. Thank you, everybody.